Well, good afternoon, everybody. My name is Sean van den Berg. I head up client education at PSG Online. Welcome to today's webinar on technical analysis, focusing more on Japanese candlesticks. Here's the agenda for today. Obviously, many of you that are on this webinar are advanced traders. There are many that are still novices or have never ever been involved with candlestick patterns. So my objective today is a bit of a balance between the two, between the novice and the more advanced trader. So I'm going to introduce candlesticks and then go through the process of recognizing some candlesticks. But this webinar is going to focus mainly on the basic or the most common candlestick patterns out there. But also I incorporate how the other technical analysis tools, the tools we use all the time called moving averages and support and resistance and trend lines, can also assist the trader with candlestick patterns. And obviously we would touch on the technical indicators and some volume analysis and just other tools that I use sometimes to help me in making an informed decision. So I'll be highlighting one or two little trade ideas using candlesticks. And then just to end off with our upcoming webinars next month and our trading forums going forward. Okay, so that's the agenda for today. Let's move on. By the way, I have Kylie, that's one of our panelists, on the also listening in. So any questions you guys might have, please send them through on through the webinar system. Kylie will be able to answer it. If not, any more advanced technical questions, I'll try and answer at the end of the presentation. Also, I'll be following up with any questions afterwards, after the webinar. This presentation will be emailed to you guys. The link will be sent to you guys. And we're also in the process of actually recording this webinar, so you guys can listen to it again in future. Okay, so let's get started. As I say, my focus as such is just to take you from the basics. So those of you that have been using candlesticks for a while, just bear with me as we bring in candlesticks. Okay, so let's talk about candlesticks as a quick overview. The main idea of candlesticks is it helps to forecast price behavior, and I'll go into that in a bit more detail just now. So the whole idea is that you want to be able to forecast recurring market scenarios. So it's a combination of chart patterns. You know, with a normal bar chart, you're looking at day by day. Candlesticks, the nice thing about this now, you start grouping them together. It gives you a better indication what's going to happen in the market. So either you're going through a period of consolidation, and I always say that's a period you're always looking for when you're looking for a breakout from that consolidation while the market's taking a breather, or other chart patterns also highlight a potential a price move, a forceful move out of that consolidation phase. So that's what candlesticks do also. So the main idea is that it gives more insight into market conditions. You can use it as a standalone tool, but it's even better if you use it together with other technical indicators. You know, they say it's a powerful formula. So the bottom line with candlesticks, it provides more visual clues to the sentiment on the market, where the market's moving and things like that. And we'll talk about reading price action a bit later, but it just makes it easier to read or anticipate what's happening in market action. So remember, market action every day, what moves the market is sentiment, and sentiment is human emotion. So you want to be able to effectively study those emotions of the trader, and obviously that is being reflected in the share price. And bottom line, price is number one. Price action is the number one indicator you always want to look at. Everything else is secondary, as they would say. So it provides the same information as you'll see in the bar charts. It gives you the high for the day, gives you the low for the day. But with candlesticks, obviously that's emphasized, and we'll go into the anatomy of a candlestick a bit later. But the main idea is that a candlestick will highlight the relationships between the close and the opening price, and that's what's important. Either the price opened lower, closed lower than the open, or vice versa. So, as I say, the main thing is price action, and candlesticks helps you to, if I bring in my little spotlight here again, highlights or predict reversals in the market, and also continuation patterns. Those are the two things that you're always trying to do as a trader. Anticipate a change in trend, or the trend will continue up. Okay. So let's go through the background quickly. Obviously, Japanese candlesticks originated in Japan more than 100 years ago. It originated around the price of futures contracts on rice. There was this guy called Homer. There was a trade in futures, rice futures in Japan. And you saw it was a big link between the price and the supply demand of rice. But the market was very strongly influenced by the emotions. And that's what, as I say, the main thing you want to focus on with candlesticks. And that's one of the major advantages of it, is it highlights the emotions of the market. Okay. And that's what, if you understand the emotions, how they play out, if they played out in the rice futures, the same thing applies now in the financial markets in this day and age. Okay. That was, as I say, the guy in the 1700s. But Steve Nissen, he's regarded as the guru on Japanese candlesticks. And I'll be talking about some of his books at the end of this presentation, the books I've been using for many, many years. I've also got some of his DVD books, DVD courses and things like that. But saying that, there's a wealth of information available on the internet. And I always believe that Google's your best friend. You just go Google Japanese candlesticks, and you'll find a lot of information available on the internet. And I have taken some information from the website, and I've given credit to that. So the main idea with Japanese candlesticks is, end of the day, we're talking about reading charts. Why do we need charts? We want to find out where the big money is moving, especially here in South Africa, where the private investor on the market is very, very small, and institutional trade dictates the trend. Okay, so reading Japanese candlesticks or reading candlesticks is more an art form than a science. And yes, it does take a while, it takes years to master. I've been trying to master it for many, many years. Yes, the names are a bit tricky sometimes, but I'll go through the process just now, the steps you can take to start analyzing a share. But the bottom line is, once you've analyzed a chart and things like that, you need to come to a conclusion whether or not to take on the risk to place on a trade. And that's what separates a novice trader from a professional. Obviously, being able to make that decision and that commitment. Okay, so there are several factors that are worth while looking at, but obviously by analyzing these factors, you're going to bend the odds in your favor. You'll have a higher probability of being right. Okay, so compared to a normal bar chart, hopefully most of you have seen a bar chart, and the next slide will show that anyway to you. So the candlestick is very similar to a bar chart, in the sense that it displays the open for the day, the high for the day, the low, and where the market closed. Okay, what they call a OHLC chart. So the same information, just a candlestick chart. It's just they say it's prettier and more graphical. Okay, so it's just a different way of looking at prices. The nice thing about it, compared to like point and figure charts, which have been around for about 400 years, there's no calculations involved here. But the main idea of candlesticks, as I mentioned before, extenuates or highlights the relationship between the opening and closing prices. Okay, so the main thing with candlesticks, again, and I'm harping on it, the purpose is it's a visual aid. You'll see just now, when we start looking at some of the chart patterns, how these patterns start jumping out at you. Okay, so as I mentioned just now, I just want to show you the comparison between a bar chart and a candlestick chart. Obviously, the top graph shows you the open, high, low, close of a share. Obviously, the tick to the right, to the left, where the market opened. The tick to the left, where the market closed. Sorry, to the right, where it's when the market closed. And as I say, we've got that high-low range. So that vertical line will highlight the volatility for the day. The greater the bar, the more volatility. The shorter the bar, the less the volatility for the day. But looking at the Japanese candlesticks at the bottom here, you see there's much more color involved. Obviously, I've customized the charts. The more visual you can make it, the better. But it gives you much more information than just the high-low close. Now you start looking at patterns and start seeing, as I say, the relationship between the closing price and where the market opened. Okay, so we'll go into more detail in a few seconds. Okay, the major differences between bar charts and candlesticks. A bar chart, someone who's looking at bar chart will focus on the relationship between the open and close, whereas a candlestick will also look at the relationship, but much further in the relationship with the closing price today compared to yesterday, and obviously tomorrow, and that kind of stuff. So the emphasis is on progression and the change in that closing price. Okay, so as I say, it gives you a better picture of deciphering price action. So let's go into the anatomy of a Japanese candlestick. Okay, as I say, exactly like a bar chart, shows you the high-low range. It would be like a vertical line. Okay, so it shows you that high-low range, but also there's a little body in the middle of that vertical line, and that little body is what's important also. That shows you the range between the opening price and the closing price. And that also tells you a lot about the sentiment in the market. Obviously, the larger the body, obviously gives you different information compared to a smaller body. But now also this is where the color comes in. We talk about a body being filled in, okay? That is where the price closed below the open. In other words, it's a down day. On my charts, it would be red. I always try and make red, a down day as a red day, and up day is a blue day. Okay. So a filled in a body, where it's what they call a black body. It highlights the price closing below the open. Okay. The top would be the opening price, and the bottom of the body will be the closing price. And you'll see just now when we're going into more detail, and I'll show you some graphs. If it's hollow, they talk about a white body. In my situation, would be a blue body. That's where the situation where the closing price is higher or above the opening price, and that's a bullish chart. So a folding chart is bearish, and a hollow chart is bullish. Okay, so this is what I was talking about. Yeah, you got the high-low range, like in your bar charts. Okay, the high for the day, that'll be the low for the day. What's important now is, as I say, that on the bar chart, you'll be the tick to the left, will be the opening price, and where the market closed, it'll be the tick to the right. Okay, so now that body highlights that range between the opening price and the closing price. So in this situation, this is what they call a white body. It's not filled in. This is bullish. Could be because the closes are higher than the open. Okay. If it's a down day, if it's bearish, you can see where the close, the market opened higher and closed lower. That's why it's filled in. Again, as I say, you got a high-low range. They talk about an upper shadow and a lower shadow. So these little sticks sticking out at the ends, okay, protruding from the tops and the bottoms of the real body. I've read so many different books. Sometimes they call them shadows, sometimes they call them wicks. A lot of people think that Japanese candlesticks refer to a wick. They also refer to the bottom here as a tail. Just understand, obviously, the interpretation also. It just shows you that, obviously, the market extended way above the open and high, a low range. Okay. As I say, the hollow full body, it's called the real body or the body. Remember, hollow candlesticks, the close is greater than the open. It's highlighting buying pressure. Okay, there's more buyers than sellers, and vice versa. Obviously, if it's a filled body, the close is lower than the open. That's selling pressure. There's more sellers than buyers. Those thin lines, as I say, they're protruding from the top and bottom. Those are called shadows. Obviously, the upper shadow will be the high, and the lower shadow will be called the low. Okay. The steps or the advantages of candlestick charting, it is easy to interpret it. And I know this webinar was entitled Advanced Technical Analysis, and I always thought, you start with closing line charts, you progress to bar charts, and maybe to point figure charts, and then one day when you're big and you're a serious trader, you start looking at candlesticks. But the more I play around with candlesticks, I understand that it's even a good place for a novice trader to get involved. So, so we just get rid of this now. So it's better for a novice right from the outset to get involved by looking at these charts because they're easy to use. Your eyes adapt easy to the information on the charts. What puts off a lot of people is the names. We're talking about some of the candlestick names just now. Yes, they might be cool. What's more important is interpretation. What is the chart telling you? So we get little names like Shooting Star and Abandoned Babies and three widows and things like that. But the main idea is it makes it more descriptive. That's the idea of the names. So candlesticks they helps you to highlight turning points, obviously reversals from an uptrend to a downtrend and vice versa. Okay, so those are just some of the advantages or benefits of it. Anything about candlesticks, the same as the bar charts, doesn't tell you the sequence of the events. Okay, so it highlights the relationship between the open and close. Okay, and that's okay, and that's quite obvious. You can see it on the screen with open and close, but you don't know which one came first. Okay, so here's two scenarios. In sequence one, we got the opening price. Let me just go back here again. Highlight my highlighter. We opened, we dipped down a bit, we rallied up, and then we closed just off a high. Okay, that tells you that there's strong demand, there's a lot of buying pressure and things like that. So that is quite descriptive. Okay, you can see that. In the second scenario, we had this open, we rallied up, and we came back, we closed, we made a low below our open, and we rallied up again. Obviously, also quite descriptive. There's three moves in that scenario, but also that shows much more volatility. and some selling pressure. Obviously, you can see the lowest, lows, and open. As I say, the candlestick chart doesn't show you that sequence. That's only one of the only disadvantages of a candlestick. Okay. So what's important, if you want to go quickly into the steps on how to identify a candlestick, we're looking at the color, at the highlights for you straight away as the market moved up or down. Secondly, the length of the candle. Okay, the range of the body and things like that also important. And then the length of the wick or the shadow also shows you where the market's moving. Okay, so obviously a top wick, okay, a long wick at the top. On a short candle suggests bullish, the bulls are pushing the price higher. The bullish push has been rejected by the traders, obviously, and that's where sometimes the market turns against you. You think it's going one way, and next minute it changes, goes against you. And that's what Japanese candlesticks can do, highlight those changes for you. So let's go to more the nitty-gritties. Let's talk about the body sizes, the size of the long or shorts as such. Long bodies, okay, we've got our two long candles here. It highlights obviously strong buying, okay, and there's strong selling, okay. The longer the body, the more intense the buying or selling pressure. Short bodies, okay, imply very little buying opportunity. Remember, he has lots of interest in that share. There's a lot of volatility, and with short little bodies, there's no interest. Yeah, people say let's look at the big bars, but you want to focus on the small bars. You'll see just on the later slides we talk about wide-ranging charts and narrow-ranging charts. Okay. So white candles, strong buying power, strong buying pressure, and in long blacks, obviously strong selling pressure. Okay. The further the close is away from the open, the better, and vice versa when the market's falling. Yeah, we open, yeah, we closing. That will highlight to you the buying pressure and the selling pressure. Okay. That's just the size of the bodies are important. Then we start talking about the shadows and the wicks. Okay, a long shadow like this here, okay, upper shadow and a long tail or a lower body. Okay, remember that's highlighting the range first of all, and obviously the session high and session lows. Okay, so long shadows shows that the trading action went way past the open and low range. You can see that's where we opened and that's where we closed, but we went past those ranges. And same with this here, we went past those ranges. Short shadows, obviously, that we traded near the open and close. So there's not much activity, etc. Okay. So what's important again, it's just that the buyers, there's war going on between the buyers and sellers. So we're trying to push the prices higher, and eventually it fails out, and we close at the bottom. So that'll be very bearish, and that'll be very bullish. The sellers try to push the market down at the end of the day, and we still close up near the high. That'll be very, very bullish. Okay. So the buyers will be in control in that situation. So we're talking about buyers and sellers. Always remember, I can try and simplify it again, go back one step. Talk about there's only two groups of traders in the market. Either a buyer or a seller, either you're bullish or bearish. Okay. So for every buyer there has to be a seller, and for every seller there has to be a buyer. The main question you always have to ask yourself, and this is where candlesticks are important. I always try to ask myself, what is happening with the price action? Who's control? Are there more buyers than sellers? And we'll go through this whole process just now. Obviously, if the price closes near the top of the range, buyers are more aggressive. Okay, they're willing to get in a higher price. Sometimes we talk about panic buying. We have this little in normal bar charts. We talk about gaps. In Japanese candlesticks, we talk about windows. So you get panic buying, runaway gaps and breakaway gaps and exhaustion gaps and that kind of stuff. Same thing applies now with the Japanese candlesticks. So when the prices are falling, obviously the close is below the bottom of the range. There's more sellers. They're being aggressive. They're willing to get out in any price. There's a panic selling. Okay. So what's important, the price relative to that range tells us who's winning. Okay. Where the market closed relative to the open, and obviously that range tells us a lot of important things. And this is what I want to highlight here. This is one of the most important things you can know as a trader in reading candlesticks. Okay. That price, with the close in relationship to that range. Okay. So let's talk about wide-ranging candles. This is not Rugby World Cup. People always think of WRC. But wide-ranging candles, obviously it's just highlighting greater volatility. There's a lot of interest in the market. Okay, you'll find that prices tend to move in the direction of obviously the candle, whichever way it's going. So you want to look to the left of that last candle and gauge the interest of the buyers and the sellers. And you'll see in the next slide where we highlight that. The main thing is we always talk about trading, the trend your friend. So remember, trading the direction of the market, trading the direction of the trend and the candles. You want to know, is there interest in the share? Is there accumulation? And that's where the volume comes in, or is there distribution by the institutional traders? Okay. On the opposite side of the coin, narrow ranging candles obviously shows you low volatility, little interest in the share at that point in time. But this is what you want to focus on. You want to focus when everyone else is not looking at the market, looking at the share. That's where you want to focus on, because low volatility leads to high volatility. And we talk about breakout trading. So Candlesticks highlights it for you. You want to enter the trade in low volatility and obviously exit in periods of high volatility. And here's my example. Yeah, we've got Aspen. Okay, we're moving in the sideways range. This was before the results came out recently. Sorry, it was going back to December. But we were moving in a nice little narrow range, roughly about 5 rand range, and then we had this little breakout. Okay, you can see the length of those bodies. They were quite narrow. Okay, and then we had this long body. That is volatility, and then obviously the market took a breather again, and from there rallied on. Okay, so you want to be in a situation, yes, like my support and resistance, well, in this situation, a resistance trend line, and when a minute it breaks out above it, you're going to get into the trade. So this is what I highlight for you. I just want to highlight, for example, the size of the body, the range, rather, of the body, compared to a narrow ranging body compared to a wide ranging body. Okay, so I'm going to try and simplify it again. There's 6 types of candles. You get long whites, long blacks, we've spoken before, small candles, and upper shadows. I'm not going to go through this again because there's a bit of repetition, but obviously when you get this presentation, it also highlights for you. Those are only 6 patterns you want to look for all the time, and it's a combination of those patterns that's important. Okay, so there's 8 steps. I look at it as 8 steps that I go through. First of all, I understand the parts of the body, and we've gone through this already, what I call anatomy. So you got to ask yourself the body, where is the market open relative to its closing price? Are there any tails or shadows as such? Remember the tails at the bottom and the shadows at the top. Okay, I prefer to use a wick that gives me a better description as such. My second question I always ask myself, what is the time frame? And obviously you can see that at the bottom of the screen. Are we looking at a daily chart or weekly chart? Remember, it doesn't apply, I mean, it applies in all time frames. Okay. What's important, obviously, from 2 minutes to years. So what's important is just to understand what is the time frame, so you can understand, obviously, the sensitivity to price movement. You also want to look at the price moving up and down. Again, the color of the chart is important. Remember, black is bearish and white is, black is filled in. That'll be the market closed down. Hollow or white candles are bullish. So got to go through that step quickly, the body, the time duration, and then the color of the chart. Then I start looking at the relationship of the open to the close within the trading day. Obviously a black candlestick, I want to see where the market opened, okay, to be at the top of that range, and the close to be at the bottom of the range, and vice versa with the white candlestick. So I'm just chunking down a bit deeper now into the relationship between the opening and closing price. And start getting a feeling for the emotions behind the market as such, or the buyers and the sellers. Then again, I want to look at the range between this is where I start looking at the body of the candle, the range, okay, the length of the whole from the top, from the high to the low, and obviously how the market traded within that day as such. Okay, and so you interpret the body, okay, the long body or short body, and then the tails and things like that. Bottom line, you want to put everything together, and you want to ask yourself, okay, now I'm looking at a short black candlestick with a long tail. That will remind me of what they call a hammer, top of the market. Sorry, people, this keeps on popping up. I should have got rid of it before we got started. But that's the interpretation, the process to go through that. Let's go through some of the candlestick patterns quickly. Okay, there are a lot of patterns out there. So what I want to do is just highlight 10 positive, 10 of the common ones, 5 bullish, 5 bearish. What's more important is understand what is happening in each of those patterns. So yes, some of the names might be daunting, but as you'll get used to them very quickly. Again, on a highlight, use it together with other technical analysis, and obviously we'll show that a bit later. So here's the 5 most popular bullish candles as such. Remember the highlight reversal patterns in the market. Obviously, most of the time these charts or these patterns will pitch up after a pullback in price. So as I say, that's where we anticipate a reversal up. By the way, I got this from a website called swingtradestocks.com. There are a lot of other websites available like that, but this is where I got this images and that from. So the first pattern we want to talk about is bullish engulfing pattern. It consists of 2 candles. So this is a combination of 2 candles. On the very first day, we've got a narrow range candle, okay, that closes down for the day. So that's, whoops, let me get this quickly. That's where we opened, and that's where we're down. You can see it's also full in, so that's a bearish candle. On the second day, obviously, we've got a wide-ranging candle that engulfs, envelops the whole trading range of the day before. Okay, and that's what the kind of pattern you're looking for. So interpretation is, sellers are still in control in this situation. Okay, but now the narrow, the volatility is low, because obviously the next day the volatility increases. So they're not so aggressive in the next day. So the buyers are overcoming the sellers. In other words, demand is overcoming supply. And obviously this is where we take control. The trend reverses from a downtrend to an uptrend. Okay. Here's an example. And this is what I find very, very important. If you find this pattern near a support level, it gives it much more emphasis. Okay. You got a very good chance of we're having a bounce from here. Okay, so that's, you can see that this high-low range envelops the whole previous day's body. Okay, that's the kind of thing you're looking for. And obviously from there in the market already. Here's ACI recently. Again, we have a sideways market, bouncing off support, and we've got a smaller body there, and the next day's candle, or the body, engulfs the whole day, the whole candle of the previous day. And you can see how the market bounces up. Okay, that's where the market closed for the previous day. You can see next day is a serious gap up. So that's a bullish signal. Excuse me, that's bullish, and the next day that's confirmed with another bullish signal by the price gapping up. The market opened higher than it closed the night before. Okay, so those are the kind of things you're looking for. Bouncing off a support, bouncing off a very nice support trend line here, bouncing off a support level here. So all these things come together, help you to look at a higher probability trade. Let's look at a bullish Aspen pattern. It's called a hammer, and I always think of the idea that it's hammering out a bottom. So the share opens up. Okay, that's where we opened. Okay, the sellers try to push the market down. Okay, we try and drag the market down, but at the end of the day, the buyers coming to the market, and we have enough strength to close at the top of the market. Okay, so they usually cluster around stop losses, and I've got an example just now. But remember, this is where a lot of the professional traders will come in, because the small private investors have been shaken out now, and the big guys will come in now. So when you see this pattern near the bottom of the cycle, you've got a very good chance we know that we're hammering out the bottom of a trend. So yeah, we've got an example of a share. What I find a bit useful of this now, and I'm the kind of person that I like confirmation, so some of you might have got in straight away. But I see here, yeah, we've got a exhaustion gap, a gap down, and then obviously we've got this little hammer, and the next day's candle engulfs that little body, so that's also bullish. But you can see it recovers or closes that window also, closes that gap. That's very bullish. You can see how the market rallied from there. Here's an example. This is on Xfinity. This is an ETF where this was acting. This level here was acting as a support level, and as I say just now, it can be hovering around the stop loss level. So all these stop losses were triggered. You can see these gap down, but there we go. This is a hammer. This could be a potential reversal pattern up. I like this. You look at the next day's graph, or next day's candle to confirm. Arami. Arami is a Japanese word for pregnant. So I always think of this as the mommy, okay, the long body, and there's a baby in front. Okay, so that's what we're looking at. Basically, it's just highlighting that the downtrend is slowing down, momentum is changing, and we'll move up again. Okay, so although the sellers are still in command here, the buyers come in big time the next day. Okay, so let's look at some examples. You can see that the body is smaller than the previous day. This is just you can say the inverse of a bullish engulfing pattern, but don't get confused between the two of them. Okay, so you can see that it's highlighting we're going from a downtrend, bit of a sideways market, and eventually we broke out of it and we started accelerating from that downtrend. A bullish piercing pattern. I find this useful, and we talk about the wind software just now where you can scan looking for these patterns. But again, a two candle pattern. Okay, on the first day we got this wide body, and the market closed down. That's where we closed. That's where we opened. The next day, obviously, that's where we opened. So we get down. Okay, but we closed up higher, and we closed up more than 50% of our previous body. Okay, so it's a very, very strong reversal pattern. I like to look. This is one of my favorite patterns. I always look for. So this is a chart that does it quite often. I can't remember what this chart was, but you can see it pulls back quite strong into more than half of the trend, and you can see how the market rallies from there. Okay, again, this situation nearly became a full-on engulfing pattern. But again, that's where we opened. Sorry. Yeah, that's I'm looking at the wrong one. That's where we opened, that's where we closed, but we closed halfway through more than 50% up into the previous day's chart. But the main idea is you can see, and again, these little gaps, this is a panic sell, a panic buying, get me in the market, get me in. And that's the kind of thing you're looking for. You want to take advantage of that little rally. Okay, so bullish piercing pattern, very strong reversal pattern. Okay, dojis, a lot of people like dojis. I prefer dojis together with other charts. They might be the most popular, but the main idea of the doji is highlighting indecision in the market, where the close and the opening price and the closing price are very, very close together. Most of the time, they trigger reversals in the opposite direction, hence the popularity. There are quite a few different dojis we talk about just now. Dojis are these little things here. They look like little crosses. Okay, the high-low range, and then the open and close are very, very similar, so it makes like a little cross. Yeah, we've got some dojis here too. As I say, with sideways market, indecision, down. Okay, sideways market, indecision, up. Okay, so it highlights that for you. You get these, what they call long-legged, obviously the high-low range. That's one kind of doji. You get a dragonfly doji, and you get the gravestone dojis. Obviously in relationship to the previous trend and within a range, wherever the case might be. Yeah, we got a trend. You say this from normal chart patterns, this might be what they call a flag. There's our flag pole, and then we've got our flag. We've got this little range where we're making lower highs and lower lows, and then we've got our little doji. So it's highlighting a bit of indecision, and then next day we break up, and a slight little doji there, and another little doji there. But you can see we break out of it, and the trend continues. So it highlights that indecision in the market. Important reversal coming up soon. Okay, so it's a bit of a leading indicator. Here's a dragonfly doji. You see that at the bottom of the screen, and very, very strong reversal from there too. There's a gravestone doji. Remember, this is where the open and close at the bottom of the screen. We're bouncing off that support. Again, remember, indecision. And eventually we move out of this market. So we had this little rally, indecision sideways, and then we moved up from there. Okay, so those are some of the bullish patterns. Let's move on to the bearish patterns quickly. It's very similar, obviously the opposite of the bullish patterns. They come after a rally, so the market's moved up. Now we're going to pull back. So again, it highlights possible reversals, just like the bullish patterns. Obviously, the names of the game are very descriptive. Again, you can read up more about them on the websites and things like that. As I say, these are the popular bearish ones. Okay, engulfing pattern. We're engulfing the previous day's body. Okay, remember, it must be a update. The bulls are still in control. Next day, we have the sellers that come in with a vengeance. We engulf the previous day's body. That's very, very bearish. You see what happened from there, and the market pulled back. Okay, so anyway, you can pick these things up if you look at the charts all the time. Okay, here's a shooting star. I just call it an inverted hammer. So people call it inverted hammer, some people call it shooting stars. But again, at the top of the market, anticipate a market moving down from there. Okay. Bearish Rami. Remember, this is where with the mommy, And the baby, remember in this situation, the baby is bearish where the mommy was positive. So again, a bit of a sideways market anticipation of a downtrend. Okay, that's what happened here. Okay. Dark cloud cover, as I say, with the piercing line, that will be the bullish pattern. Dark cloud cover will be the opposite now, will be the sell. I try and scan for these kind of patterns and help anticipate a change in trend together with my stochastic indicator. You'll see just now I've done some examples of that for you. Again, the bulls are still in control. But the next day, that's where we opened. We get my cursor again. That's where we opened, and we closed halfway in the previous day's range, more than 50% into that range. That is bearish. Obviously, you can see how the market pulled back slightly from there. Okay. Dojis, as I say, they're applicable at the top of the market, the bottom of the market. Remember the highlighting turning points. So obviously, start seeing these patterns together with others, anticipate a changing trend. Okay. So let's bring in some other technical analysis. Resistance, other trend lines, and things like that. Okay. So let's move forward. Moving averages, I've been advocating or been talking about using a 50-day and a 200-day moving average for a long time. The main idea, the 200-day, which is the green one, is the furthest away from the graph. The main idea here, it helps me establish whether we should be more on the long side or the short side. Obviously, I'm referring to single stock futures and CFDs, where the 50-day moving average is much shorter and hugs it. So obviously, I've showed you, this is showing you 4 years of data. So it doesn't show you the candlestick patterns properly, but you can incorporate it. Obviously, you can make shorter time periods also. I'll go right down to a 7-day and a 15-day and that kind of stuff. But what's important is the crossovers. So there, that's bearish when the 50-day cross is below the 200-day. That's what they call a death cross. Anything below that is bad news. You can see for nearly 6 months the market was down or the share was down. And then we have the crossover again. Anything above it will be good news. Okay, that's what they call the golden cross. You can see how the 50-day moving average hugs the share price quite closely. So your 50-day moving average can also act like a support trend line. It comes back to that level, provides support, and market bounces from there. So incorporate moving averages into all your charts. Yeah, we're looking at a chart. Obviously, I've zoomed in now, just showing you about 3 or 4 months. But I want to show the candlesticks now as such. And obviously that range we're talking about just now, narrow range candles and wide ranging candles. So yeah, we've got an area of resistance. Okay, we need a break up above that. So there's our breakout. Okay, that was very, very bullish. Okay, the wheat area of resistance. Again, we move sideways, pull back a bit, but we need a break up above it again. Okay, so use support and resistance levels. They are horizontal to help you trigger entry points. So also I can measure that distance between the support and resistance. That also helps me when it comes to a rectangle chart pattern. That's minimum target. And obviously very close to that little target over there. So we pass our previous highs. Okay, same thing again here. I measure that distance on the breakout. Okay, there's my little breakout. That's very bullish. And you can see where my market's going. So remember support and resistance trend lines. Remember these are tools to help you make a decision whether to get in the market, get out the market. Trend lines, on the other hand, are more diagonal. I find a prominent low projected to a second point, ideally to a third point. The more times it touches, the more reliable the trend line is. The more times it touches, sorry, the longer the period, the more reliable it is. And obviously, the more times it touches, the more reliable it is. So if I connect all the lows or connect the support, that's what they call a support trend line. As long as the share price stays above it, like our moving averages, the trend is up. Resistance trend lines, I connect the highs now. The peaks as such, I want to see a breakout above it. So that would have been a nice little breakout. That's what they call a break and kiss. It broke out of it, came back, and came to kiss the previous support or the previous resistance trend line, which will act like support here. It broke out, came back to kiss it, and say kiss it goodbye, and ran away. Yeah, you can see a bit of you can call this a triangle, symmetrical triangle, continuation pattern. The trend is up. Again, the breakout. That's what you're looking for. The more times it touches, the more reliable it is. As long as the share price trades below that resistance trend line, the trend is bullish. Bearish, sorry. It breaks out above it, very, very important confirmation, changing trend. Together with the moving averages, tells you that we're bouncing up from there. That would have been a very strong buy signal. You got our candles breaking out above it. We got a bit of a high there. Very, very bullish. Okay. But obviously, there are a lot of technical indicators. In the Went software, for example, there are more than 100 technical indicators. I use personally about 3 or 4. We've been talking about this for a while now. This is a stochastic indicator. It's great for short-term trading. Mainly highlights overbought and oversold levels. So obviously, when it goes below 20, it goes up through the 20 level again, that'll be a buy signal. I'm getting very close to that bottom of that cycle there. And obviously, it can pull back again. That will be in the sell. My moving averages still tell me to stay in there. And obviously, my other indicators also are selling. But that would have been a very strong sell signal in the sense that we are seriously overbought. Okay, now we're pulling back. So I'm getting out quite close to the top here. Obviously, this is a few more days, so the cycle's a bit longer. So this is more for a swing trader, more of a position trader rather, from if it's going on nearly 2 months now. And so you can incorporate all these other little charts and shit. And this is what we do on a daily basis of the trade ideas, incorporate overbought and oversold levels. Well, I also prefer to use a lot. Remember, we're looking at price action, that's candlesticks, and I'm using secondary indicators like stochastic and all those kind of things to help me make a better decision on the RSI and the MACD. But also very important to look at volume. Volume confirms price action. So here is the volume histogram at the bottom here. So that little point there were a lot of sellers obviously pushing the price down. But remember what I said just now, more sellers, for every seller there has to be a buyer. And yeah, we've got a situation where the market started moving up. But this is what they call on-balance volume. It's the running total of volume. That tells me that sharp little angle there, that's accumulation. Together with my volume price trend, those are the kind of things I'm looking for. So using it with my candlesticks and my breakout charts, you're getting the odds in your favor. So those are just some of the technical analysis I'll be using. There's also other tools I use on the Went software. It's got a thing called the highlighter. And built into the highlighter are predefined scans already. You can if you go click on alerts, and there'll be a little drop-down list, you'll find a whole lot of different candlestick patterns you can scan. Obviously, what's important is the interpretation. We spoke about a bearish engulfing pattern just now, and as I say, incorporated with my stochastic. You can switch it on or off. Obviously, both criteria is selected to be very strong. Okay, I did a scan this morning, and lo and behold, our sign-off came up. Okay, bearish engulfing pattern. So that was on the Went software. I also use a program called Metastock. What I like about the Metastock is that they've got a thing called the Expert Advisor. You can attach or detach commentary. So now in this situation, I'm attaching candlesticks. So to highlight or identify some of the Japanese candlestick patterns for me. So this gives you a confirmation tool also in interpretation. So just as I say, the tools I use also. Okay, we're getting to the end now. Let me just go quickly through some of our trade ideas we've had recently. There was PPC. We had this very important resistance level we need to break out above. It was forming a rising, what do you call it, a rising ascending triangle. That was our bicycle there, obviously a breakout above it. So we got into the share at 34 Rand, and our target price was 36, which was the previous high, 36.50. Okay, they did a nice little run. Obviously, the moving average, we weren't oversold as such, but they were confirming the trend. So we acted more as our momentum indicator. Got to the stage where we got a bit nervous. Obviously, we got into overbought territory now. This is the sell zone. And eventually, instead of buying selling at a 36 Rand, we got at 36.50. We got out we revised our profits down to 36 Rand. But at the end of the day, that little trade gave us 5.88%. Remember, this is a PPC, which is a mid-cap stock, so your margin would have been 17.5%. That gave us a potential, well, it was potentially 42%. Remember, this was a few days. I think it was about 2 weeks. End of the day, we came out at 33% gain in 2 weeks. So that's what helped us with the candlesticks here. We saw these long bars happening, broke out above it. With our technicals, that's how we got into it. This is one I put out this morning. Some of you might have looked at my Aspen share, Aspen trade. I put a short on Aspen, and some people called me and they said I'm crazy to short a strong stock. Yes, I might be there, but I did highlight it that it is for aggressive trader. First of all, it is overbought, okay, both on the RSI and the stochastic. Our support is moving in the sideways range. And we spoke about this pattern earlier today also. The inverted hammer, which is a bearish pattern. Remember, the idea was it had to open, break down below that support trend line, which it did, and broke down very sharply. When I saw last, it was down nearly 2%. So this trade this morning has a potential of 7%. Remember, it's a top 40 stock, so I've got a potential of 51% gain on the share. My target, I will enter the trade at 193 to close out at 178, potentially 15 Rand in the share, and my stop loss is the top of the range, which is 6 Rand. So my risk to reward ratio is 1 to 2.5. Anything between 1 and 2, I mean, more than 2, that's what you're looking for. So we'll see. We're monitoring this trade very closely. We'll see how it goes from there. Okay, we're getting to the end of the presentation. I hope you guys have enjoyed it. Just where I've got some of this information from. The other two websites, I use swingtradestocks.com and in Candlestick Genius, but there are a lot of other websites too. These are two books I got years ago. Well, this one I got more than 10 years ago. Steve Nissen, my very first Japanese candlestick book. This is a revised edition. And the website I use for all my books is a thing called Traders Library. They have a special on all the time. Some of you might use it. I find them very, very reliable, and the prices are not bad, especially when they have sales on. This is one I've just bought recently, property from Japanese Candlesticks. The reason why I bought that was the DVDs. It's got more than 6 hours of Steve Nissen talking and things like that. So those are the two books I also recommend. By the way, these books are not cheap. You're talking about a few hundred Rand, but they're worthwhile. If you want to learn more about Japanese candlesticks, and as I say, Steve Nissen is regarded as the guru, the Western guru on Japanese candlesticks. Okay, so a quick summary before we handle some questions. Remember the advantages. Candlesticks are easy to interpret. They're easy to use. So those of you that are novice traders, start looking at them. Yes, don't get intimidated by some of the names, but it's a very good way of identifying market turning points. Okay, and I just want to highlight again those steps. And it's time to establish for yourself a process. How do I interpret the price action? And this is the steps I suggest that you look at doing. Okay. Just upcoming webinars in April. We got one on exchange traded products. Obviously, we're going to focus on exchange traded funds. There's 38 of them, and there's exchange traded notes. There's 22 of them, and these are great tools to use as a trader or as an investor in combination with your equity portfolio. And at the end of April, we're talking more fundamental analysis. We're going through the cash flow statement, the income statement, and the balance sheet. More specifically, looking at financial ratios and things like that. Bookings are open. Remember, these things are limited to the top 100 people, for the first 100 people. Then we've got our upcoming forum meetings. We've got our very first forum meeting, Traders Forum meeting, coming up in Durban in 3 weeks' time. So those of you in Durban, there's still lots of space available. I always find the Durbanites wake up the day after I get back and they say, when am I coming down to Durban? So please go and book. There's still lots of space available. And in Joburg, we're back here in May, and in Pretoria again in June, and in back in Joburg again, and in Cape Town in August. Okay. So let's see some of these questions. Sorry, let me just see in conclusion. This presentation will be sent to you guys. Those of you that are looking at short-term trades and looking at those candlestick patterns, one of the tools you can subscribe to would be the Stockbroker, as our daily analysis for those of you that are trading single stock futures and CFDs, and those webinars. And from our side, good luck and happy trading. Let's handle some of these questions quickly. Hopefully, Kyle has handled most of them. Let me just grab this quickly. Sorry, I'll just see if I can read some of these questions. There are interruptions in the communication. Okay, I'm sorry about that. I wasn't aware. Pattern 2 does. Let me just go into this quickly. This is from Walter. Let's find some questions here quickly. Obviously, a lot of questions on different patterns. I'll have to get you guys off to more specific questions. Can you email the presentation? Yes. I'll be seeing the link to download to look at the presentation. So I'm just trying to make this a bit bigger so I can just read the questions. And I can see that Kylie has answered most of these questions already. The gap. Yeah, I have watched analysis where gap between candles. This is a question from Richard Hutfus. Where gap between candlesticks from one day to another. What do these mean? Gaps. Okay, the gaps apply is the same as in Japanese with the bar charts. Gaps. Today's low is higher than yesterday's high. As I say, you can call it panic buying or panic selling. And those are very bullish or very bearish, depends on which way the market's going. Sometimes those gaps are full or closed, but most of the time you find these things run. And that just gives you an indication of the human emotion behind it. Remember, just panic buying, panic selling, emotions have gone crazy. So a very, very useful pattern to look for. Anton Rocha. Okay, I spoke to Bob this morning, Bob Magda. Yeah, I'll be answering your question after this anyway. I'll send you my email and the process how to do that, Anton. Okay. Hein, I understand it's been sorted out. Please explain how you calculate the risk-reward ratio when trading. Single stock futures, Frankie. The idea is that with risk reward, I want to risk 1 rand to make 2 rand. So the idea is you calculate the difference between your entry price and your stop loss. That'll be your risk, get in a few cents, a few rand as such, 2 rand. And then I calculate my reward. That'll be my entry point to my target price. So let's say, example, in this situation, my target price was, I'm buying at 2 rand, I want to sell it at 4 rand. My risk-reward ratio will be 1 to 2. Okay, in the sense that I'm dividing the risk, my stop loss 2 rand into my 4 rand, and that's how I get that scenario. Okay, I hope that answers the question. Very important to calculate that for you. If it's less than 1 to 2, don't put on the trade. It's too risky. PPC trade shows a doji before resistance level breakout. Seems doji was wrong. Okay, Walter, I'll have to look at it and come back to you. Anton Rocha, thanks. Okay, Walter, I have to come back to you on that question too. Well, I think I've answered most of these questions already, and I think my colleagues have done the same. Obviously, going forward, we will look at more candlesticks presentations, and we'll look at other chart patterns. And those of you that might be a bit more advanced, we might even go so far as to have go-team meetings. That's where we actually have live. You can talk to me, and there'll be a webcam and that kind of stuff. Those of you that might be interested in that, and obviously this is more advanced traders, let me know, because obviously there it's limited to 25 people. So that's something you can look at going forward. Okay. So guys, I hope you've enjoyed today's presentation. If you have any further questions, there's my my email address, there's my contact number, and as I said, the presentation will be sent out to you guys. And this presentation is being recorded, so hopefully you'll also be able to download the recording and go through that also again. Thanks for your participation, thanks for your support, and we'll talk again. Thank you very much.